Elis just bought Lavartex, the market leader in Mexico. Very interesting transaction, and this is a critical review. Hi, my name is Christian Wurzelball. I support the textile service industry with management training, now in Textile Service 4.0, and practical hints that they can implement right away. Yeah, so that's an interesting video. I actually wanted to make this video already in February because I realized that this has to be a Lavartex already after Elis announced this in their January report. But then I had other things to do, and so I didn't record the video, but I had already some of the slides, so this is here the video. I will structure this video in a few parts. So in the first part I will talk about the performance of Elis for a brief moment. Then I will talk about the performance of Elis in Latin America, because this is important for the context, because they refer to their success in Latin America. So I make some comments there. And then at the later part, I talk about the specific acquisition of Lavartex. There are then timestamps in the video, so you can go to the part of your liking, or you can watch the whole video. And if you like it, then give it a thumbs up and subscribe to the channel, and you'll see other videos of mine. So now a brief performance overview of Elis. So there was actually an increase of the share price since the IPO of Elis of 388%. Oh, sorry, this was not Elis, this was Cintas. So Cintas, the market leader in America, had actually has now a five-fold share price, and they also paid quite a lot of dividends in the meantime. So that was the performance of Cintas, and the performance of Elis was actually minus. So Elis is for the 7 years minus 9.2% as of today. So basically, there is no return when you bought an Elis shares in 2015. Sorry. Yeah. So that's the performance of Cintas and Elis. And the question is then, why is there such a low performance of Elis? And I think one of the reasons, not the whole reason, but one of the reasons is actually their M&A activity. And I've presented this chart already a few times, so there are other videos of mine that are going into more detail on this chart. So when you take the revenue of 2012 and you just add the M&A, so if there's no organic growth, if there is no price adjustments, it's just revenue of previous year plus M&A activity equals revenue of next year. Of course, this is artificial. And in this case, you would end up with the orange line. So the orange line is just the original revenue plus the M&A activity. And then you have the actual revenue. The actual revenue is in blue, but you do not see the blue line because it's just behind the other line. So there is basically no organic growth of Elis beyond the M&A activity. And when you add the inflation, then you would have had the gray line, and you see that the forecasted revenue of this year of Elis is below M&A plus inflation. Where is the organic growth? Or do they burn all the customer lists that they acquire? That's the question. And this is most probably the reason why their share price performance sucks. Sorry. And now to South America. South America, the biggest success story is, of course, Brazil. And So Chile and Colombia are not as big as the acquisitions in Brazil. And there you see that they basically started small, and then they acquired companies, and now and they also increased the margin here. So that's the success story. I don't know. When you look at the organic growth, you need also to compare it to the inflation rate. So inflation and price adjustments are actually part of organic growth at Elis. And when you grow 5%, but inflation is 9%, as in 2015, then actually you had a negative growth in market share from my perspective. They changed it in the next year, so inflation was 8.8, and then it was 14.8. The year after, the organic growth was basically 4%. Then it was less than 3%. Then it was a little bit more than 3%, and then it was a little bit more than 3%, and then it was 4.5%. So I do not know how they end up with a number of 9% organic growth. It's basically a mixture of both inflation and getting new customers. But actually, there's another part of the story as well. I do not know the numbers because there are no statements about this. But I really assume that they changed the revenue structure, the customer structure, from customer-owned goods to rental. That's at least an assumption. I don't know whether this is true. Maybe it's wrong what I'm saying now, but I'm very suspicious that they can increase the EBITDA margin without changing the business model. So I assume that the EBITDA margin of 2017 was impacted by customer-owned goods. So they had a lower margin, and now they changed it to rental, and then they have a higher margin. But they also need to purchase the linen. I don't know. Maybe it's a good question to the CEO at the next meeting. Maybe I'm completely wrong, and it was a success story on how to turn around the margin. But it's a question. And I'm not so sure whether the increase in the margin is actually, in the EBITDA margin, is actually just a changeover from COG to rental, or whether it's an actual improvement. Because there is no EBIT margin on this chart. For some reason, I don't know. Yeah, and then of course you have the FX risk. So when you buy something outside of the Eurozone, then you might encounter some foreign exchange risk. In this case, it turned out to be the case. So they bought, for instance, Atmospheric in 2014. And back then, this company had a revenue of 90 million euros. But this was at an exchange rate of 3.3 Brazilian pesos to real, pesos, I don't know, to the euro. And now we have an exchange rate of 5.5. So the revenue of Atmospheric of 2014 is, with current prices or current exchange rate, just 53 million or 54 million euros. So the EBITDA multiple, the EBIT multiple, the revenue multiple that you paid back then for Atmospheric to the shareholders of the previous company is frozen in time, and it's based on 90 million. But right now you have only 43 million left in your books, and when you add everything up, so you have different exchange rates for different companies. You would have had an revenue of these companies without FX risk of 250 million. and you end up with a current revenue of 154 million. So that's basically the exchange rate risk. And in the case of Brazil and in the case of Elis, you would have had to increase the EBITDA multiple by 50%. So I do not remember now the multiple of Atmosphere. So if it was 5 or if it was 4. So say it was 4 times EBITDA. In this case, the actual multiple is 6 times. So you need to increase every multiple in the case of Brazil to the current exchange rate. Yeah, so that's the story with the exchange rate. So at the end of the day, I do not know whether South America, Latin America is actually a success story for Elis. I'm really not sure. Actually, I believe the opposite. I think they burned quite a lot of cash. They burned quite a lot of value in Latin America until now. Okay, and then there's a nice quote from from Albert Einstein, and he says, "Insanity is doing the same things over and over and expecting different results." Yeah. So let's go to Mexico and buy the market leader there. And it's a nice story. So it's obviously a very modern company. They have modern plants. They have German machines, and most of the machines are German. They have RFID technology implemented. They have a nice marketing. They have a good service structure, and I think it's fine. It's a good company. But they're buying it for an incredible high price. The EBITDA margin is right now at 38% EBITDA and 18% EBIT. So how do you expect that Elis can increase the margin in the future? Will they increase it to 40%, to 45%? I don't know. We'll see. I'm really curious. I don't know. And then, of course, you have the breakdown of the market. This was probably also an impact of the pandemic. So maybe it's different after pandemic. But during the pandemic, they had an 86% market share in healthcare. Most of the contracts are, I think, with public hospitals. Yeah, that's interesting. Yeah, and they are all over the place in Mexico, and it's a big company. It's the market leader, and yeah, I think you can read the slides yourself. There's no added value if I read it to you. So basically, it's more of the same, and you have again the currency risk, and the interesting thing is that when you look at the 10 years government debt, so the yield of the Mexican government bond, so we're talking government, not corporate, which is in Europe something above 0, is 9% actually in Mexico. So I would assume that the refinancing of Lavartex is actually at 15%, or I don't know what's the number, what's the interest rate of Lavartex of the target. So Elis is buying a company that refinances itself with 15%, and they take cheap money from Europe at an interest rate of something like 4%, and buy assets in Mexico. And this is basically the danger, that you inflate the purchasing price by doing this. So that's the foreign exchange risk. And of course, there is a reason why the interest rate is so high. And and there's a reason why the financing in Mexico is so constrained. And if you take cheap financing from Europe, then you have to be very careful that you do not overpay your target. And the next thing is, of course, corruption. I do not assume that Lavartex has any corruption in dealing with public hospitals, but at least you do not know. So Mexico is as good as Pakistan in the corruption index, and even worse than Niger. Yeah, so that's Mexico. And in this case, I would assume that a purchasing manager in a hospital takes some bribes from the service provider. At least that's my suspicion. So if you have a really huge market share and you do not have any purchasing manager that takes bribes, I don't know whether this is real. And the question is whether you as Elis can bribe the same way as a family business. I'm not saying that Lavartex is doing this. I'm just saying that this could be the case, and this could also be the reason for 18% EBIT margin. And if you are stopping doing this, then you risk your profitability, because then all of a sudden you do not get the contracts. And the point is, you're not able to get this information with a due diligence, because nobody discloses whether he bribes somebody. So basically, this is a risk that you need to take when you go into a market such as Mexico. And again, I do not say that Lavartex is corrupt or that their business dealings are corrupt, but I'm saying that you do not know and you cannot know. Yeah, so that's just a risk. Yeah, and the question is, as mentioned before, if they have already 38% EBITDA and 18% EBIT margin, how can they do better with Elis? I don't know. I would rather expect that it will be worse. I would expect that there's a decline in the margin when a European company buys up a Mexican company that deals with local clients. And it's really expensive. So they have a revenue multiple of 2.1. They have an EBITDA multiple of 5 and an EBIT multiple of 10.7. Sorry, this is 10.7. It's a typo. And they have a purchasing price of probably around 160. And there is also an earnout that is not defined for the next years, because management stays in place and they will continue to manage the business, and there's an earnout. So the purchasing price is actually higher, and the multiple is probably also higher than 5 or 10.7x. Yeah, so that's the purchasing price, and it's really high. So if something goes wrong with the Mexican currency, if something goes wrong with the margin, if there is any risk that materializes, then you have overpaid this company. That's the point. And then, of course, Elis was the only bidder. In the investors call, I think it was in January, the CEO of Elis acknowledged that Elis was the only bidder for this contract. And you probably see the reason why Elis was the only bidder. They just paid too much, and there is no way that another company would be able to pay such multiples for this business. And of course, you couldn't refinance it in Mexican currency. Yeah. So that's the critical analysis of the transaction, and the question is then, who profits from this transaction? Is it the shareholders of Elis, or is it the shareholders of Lavartex? And that's the question. I don't know. Yeah, give me your opinion in the comments. Maybe I'm wrong. Maybe this is just a genius step into the right direction. I think it's good. It's a good company, Lavartex. The target is very good. It seems to have a very good market position. It's very good positioned. But I personally think that the price is much too high. And so the whole risk of this transaction is actually at Elis. And we'll see how it will turn out, how many customers will stick to Lavartex in the long run, and how the EBITDA margin and the EBIT margin will develop in the long run. So stay tuned, subscribe to the channel, and like the video if you liked it, and we'll see us in the next one. Bye-bye.